Hey all, welcome to Share Trek. This is Sandeep back with a company I'm sure you're all going to be quite familiar of, Amazon. So let's take a look what Amazon's like. Let's get started. Hey there, friendos. Welcome back. And tonight or today, we're going to talk about a company which I'm going to be honest, I have been just incredibly blind to. And I know my own biases. I've been way too focused on margins, way too focused on companies losing money, gaining money. And as an investor, I now know how I could do better. But let's get more into it. So, the big news and the big thing that has been on my mind in terms of Amazon is looking at their 2023 annual statement. This company has become profitable on its retail segment, which is just wow. That's just something where I have been so negative on for the longest time. So Amazon's retail segment has been a loss leader in order to build market share. And what a loss leader is, a company kind of has a segment or a product or a part of its company lose money in order to get customers in and get revenue from another much more profitable sector. The classic example is Costco. Costco selling its chickens, its hot dogs at almost at cost or even at a loss in order to bring people into store and bring people into the much more higher margin segments. For Costco, that is their memberships, getting people to sign on to become members. And that's a way that they drive up margins and they drive up profit. Amazon, for the longest time, has been losing money on its retail worldwide. But I understand now that Amazon's been doing that to build its market share. Actually, I remember a friend of mine who's currently in India telling me the tale of Amazon coming in and undercutting all the local suppliers and losing money in order to build itself and build its brand in that area. And Amazon can afford to do that because they have the power and the influence and especially the revenue machine of AWS, Amazon Web Services. But what am I talking about? Let's go ahead and show you what is just so intriguing to me. So right over here, you could see this is their 10K, by the way, their annual statement. You could see that, and when you see North America International, that is their retail segment. Retail is everything where they sell products, which includes their online stores as well as some of their physical stores they have in America. Um, so if we do a little bit of math over here, the 14.8 over 352, you could see that Amazon right now, despite losing money in the prior years, it has a whole operating margin of about 4.21%, meaning they're went from being negative to profitable 4.21%, which is a big accomplishment in my opinion. However, if we look over here to AWS, Amazon Web Services, their profit margin, we do a little bit of quick math, 27.14% operating profit margin. Wow, lot. That's quite a bit. They're still losing about 2.02% on their international, but that's something to pay attention to. And they're, like I said, they're building their market share. I am just very impressed with this Amazon company, how it's able to finally go profitable in retail, which is one of the most impressive things, in my opinion. Um, if we were to actually take a look at their margin and consider that and consider why I have been kind of stuck in my ways and so biased and so wrongfully wrong in a good way. Looking at their, as we see here, Amazon, they make about almost 50% margins as of the next couple quarters in their gross, but their take-home margins is really low, less than 10%. That's looking at their net margins around here. They are a earnings giant, but their good take-home profit because of that retail segment has been kind of low, which is interesting where their net margins have been kind of in line with some of the more long-term revenue boomer companies, kind of like Coca-Cola or even Costco or Walmart, where well, actually Walmart kind of loses money, but that's something for another reason. Um, Looking at their 10K and moving away from margins a little bit, looking at their 10K, their most recent earnings, they said that Amazon popped huge and went from about a $159 stock to over $170 stock, which is quite a bit, thanks to the holiday surge and higher profits, a lot of it from that retail segment. Now, one of the things that as scanning through their 10K, their annual statement, Amazon, I wanted to take a look at their debt and how's their debt situation. Their their balance sheet risk is actually quite low. They have a lot of revenue and they won't need to issue too much. And on the subject of issuing, the company did say Amazon says it seeks to efficiently manage shareholder dilution while maintaining flexibility in order and the reason they would order issue shares is for strategic purposes, including financing, acquisitions, employee compensation, and shareholder interests, which is just a fancy um marketing way of saying we're gonna issue shares if we want to. So that's something to consider. But looking more so at their debt, they have $9.6 billion currently in convertible debt given out to companies. Of that 9.6 billion, 5.7 billion is from their Rivian investment. A lot of you might know that Amazon spent a lot of money on this EV company, Rivian, which hasn't been a very good investment as far because Rivian right now loses money on every single car that they make. And it still has a $5.7 billion of that debt hanging over their head. So even these massively, hugely profitable mega tech companies, which can almost do no wrong, they have their blunders here or there. Looking at their debt, $6.82 million in bond borrowings, and this is this is a positive sign to me as a fundamental investor, where it shows how much they're lending out at, and I see rates as low as 0.57 and as high as 5.12, which are close to what treasury yields yield at. To me, that shows bond investors think this is a very low risk company of going default. That's good. That's very good for fundamental investors. Now, peeking over to their actual earnings call, that is the actual call where the CEO and other management people speak. And the company is one thing I realize is the company is just so incredibly smart where they say they're increasing the delivery speed and they're increasing delivery speed. Their increased delivery speed has increased the frequency of purchases by Prime members, and they see strength in demand from the everyday essential segment of beauty, healthcare, and personal care, where speed is most important. So this company realizes that people are very impatient and they're able to utilize and leverage that speed to get even more volume and get even much more profit from people who are more time sensitive. And a lot of you out there might understand and might know that, hey, what other company out there, when we need to buy a gift tomorrow for Christmas or for Valentine's Day or for whatever, what other company or birthdays can get a product to us tomorrow other than Amazon? And Amazon realizes that and knows there's way to get more volume from that. On their investments front, they're investing much more into same-day delivery sites and automation robotics, big spend into infrastructure. And I've been pretty bullish on infrastructure from some of my other videos. So is Amazon. They're seeing opportunities there. And this was very, very positive for me to hear. The company sees reduction in inflationary factors such as fuel, transportation, and others, bringing costs down. This might have been one of the reasons why the Amazon has been so unprofitable in the retail segment for 2022 and the prior years because of inflationary factors. But they're seeing those come down. And that's good when we hear these things in earnings. It might be a positive sign that inflation might be in the past. That might be hopeful thinking, but let's see. They're also saying that they're finding it hard to lower prices and be able to, they're finding it hard to lower prices because they're finding it hard to afford to be able to lower prices. And what that means is they can't lower prices forever because eventually they're going to take a hit in the margins. Same thing with adding selections. Eventually, some of these things will cause hits in the margins. So they're aware of that. And they're aware that means that the company can take steps to improve it. I am a Canadian, much like Raj, and Amazon has some of these other sectors which I'm not too fond of. One of which is Amazon Pharmacy and Amazon Luxury. Amazon Pharmacy says that they're undercutting pharmacy companies by up to 50%. Again, to build market share, which is so smart of Amazon. They are launching this new Amazon AI service, which is called Rufus, and AI functionality is still not out there, but just hearing from the management of this AI makes me intrigued. It's almost unsettling the way that Amazon is rolling out this AI. For example, they're saying generative AI platform. Right now, they're using it to forecast in how much inventory is needed to each fulfillment center. They're able to understand how much inventory is needed and plan ahead thanks to AI. Wow. And another thing that their AI the company has been talking about is they're rolling out something called AI buying advice, possibly through the Rufus. So right now, Amazon eventually is going to be recommending you, hey, you bought this. Why don't you also consider buying this? You bought this calculator, this BA2 plus calculator. You might like that the other finance calculator. And Amazon understands and can get us ways to spend more money than we even need, which is good as an investor, as a consumer, something to watch out for. Now, we talked about a few advertising plays and how incredibly profitable they are. We talked about Netflix and Trade Desk in the past. Amazon has their own their own advertising platform. And talking more so on Amazon Prime ads, they're saying they're adding new ad tiers to their Prime services. And a lot of Amazon folks like myself who have had Amazon Prime for a while know that we used to not have any ads, and now ads are everywhere. That's because they're incredibly profitable. And now the regular Prime tier, it's full of ads. And it's because these things generate money. We saw that in Netflix. On the topic of ads, they're looking for ways to increase advertising, and Amazon knows it can be price discriminatory. It understands through its algorithms which consumers are much more price sensitive and which consumers they can charge more from because of our buying habits. And because of that, they can roll out and sell us more things and find out which people would want the ad tier subscription and which people might not want the ad tier subscription. Talking more on that, they say advertising growth remains strong. up 26% year over year, primarily through sponsored ads. Wow. Double-digit growth year over year on their ads is amazing. AI systems, they're also using AI to improve reels and ads. And looking at AI, like when this AI functionality starts to become a thing, there might be some major, major growth. So if we wanted to wrap things up, if we want to kind of wrap up what's going on with Amazon and where there is potential for growth, Amazon's a company which it can afford losing money because it's so massive of a giant in order to build market share. And that's what it's been doing. And that's what it looks like it's continue to do. Amazon is also going to be putting out low orbit satellites eventually to compete with Skylink, that the Elon Musk company. It's got its fingers in everything and is able to do so much because it has such a massive amount of revenue. Where do I think there's potential for growth, however, is this Amazon Rufus software, this Amazon AI Rufus, where it's going to be suggesting people things and be an AI helper to help you spend more. And that's really good for investors. Something to consider, however. I also see a lot more growth, a lot more to consider in the ad spend tier. It's primarily in Prime Video. And another big catalyst to consider is going to be this international sector. And eventually, if that goes positive, and by how much positive? Right now, it's only in the negative, about 2%. If they can eventually make that go positive, that could be huge for Amazon. AI buying advice, international going positive, more ad spend. That's what I'm considering. That's what I'm looking at. Looking at those international numbers as well and how much they balloon. They got big in Germany and big in America and UK. But what about the rest of the world? How that's going to go about? So AI is transforming ads and AI is transforming how we're spending. And Amazon's at the forefront of this. And is it trading really cheap right now? If we were to look at its some of its ratios, it's kind of expensive, but on the forward growth on its 2024 mid, it's got a PE ratio of about 32%, but its price to its EV enterprise value to EBITDA looks very good because it's making a heck of a lot of money. So I'm going to be watching those sectors. I'm going to be watching those and see how it goes. But the stock itself, I might consider seeing a pullback before I jump right in. There's a lot of deals on the market, however, right now. So don't feel yourself fixated in just big tech, even though big tech looks amazing. Watch out for Amazon Rufus AI. Watch out for ad spending. Watch out for that international segment going profitable, which it's so close. And let us know what other company you want covered. Amazon. I am happy I found out my own biases and realized what's going on because this company is huge. So much larger than I gave it credit for. And don't worry too much about margins. Margins aren't everything. Company is ballooning. Wow. So thank you very kindly for giving me your time, your attention, and I hope to talk to you again about our next company. Give us some suggestions down in the comments below. Everybody out there, stay well, stay safe, stay healthy, stay based, and we'll see you on the next one. Thank you kindly.